The dot-com bubble represents one of the most significant episodes in modern financial history, not because of a single catastrophic event, but due to a sequence of decisions driven by optimism, technological promise, and unprecedented access to capital. During the late 1990s, the rapid expansion of the Internet reshaped expectations across global markets. Investors, institutions, and governments viewed digital transformation as an irreversible force that justified extraordinary valuations. This record examines how rational financial logic, applied within an environment of excessive confidence, contributed to outcomes that permanently altered capital markets and investment behavior. In the mid-1990s, the commercialization of the Internet created new business possibilities at a pace unmatched by previous technological revolutions. Barriers to entry appeared low, scalability seemed limitless, and geographic constraints diminished. Startups emerged rapidly, many with innovative ideas, but limited operational foundations. Financial markets responded enthusiastically, treating Internet-based models as inherently superior to traditional businesses. The assumption was not merely that technology would grow, but that it would redefine profitability itself. Capital availability played a decisive role in accelerating this expansion. Venture capital firms, investment banks, and institutional investors competed to identify the next dominant digital platform. Funding rounds increased in size and frequency, often prioritizing market share over revenue generation. Losses were reframed as investments in future dominance. This approach was widely accepted, reinforced by early success stories that validated aggressive growth strategies and reinforced the belief that scale alone would eventually ensure profitability. Public markets amplified these dynamics. Initial public offerings of technology companies generated extraordinary returns within days of listing. Valuations were frequently detached from earnings, cash flow, or tangible assets. Instead, metrics such as website traffic, user acquisition, and brand visibility became central to financial narratives. Traditional valuation frameworks were dismissed as outdated, unsuitable for an economy increasingly defined by digital interactions rather than physical production. Financial institutions adapted their models accordingly. Analysts adjusted assumptions to accommodate projected exponential growth. Risk assessments emphasized opportunity cost over downside exposure. The prevailing belief held that missing participation in the Internet economy posed a greater risk than overvaluation. As a result, capital allocation increasingly favored companies with compelling narratives, rather than proven financial resilience. Media coverage further reinforced market enthusiasm. Technology entrepreneurs were portrayed as visionaries, reshaping society. Success stories dominated public discourse, while cautionary perspectives received limited attention. This narrative environment contributed to collective reinforcement of expectations. Financial optimism became socially validated, reducing incentives for critical reassessment of underlying fundamentals. As competition intensified, companies accelerated spending to capture attention and market presence. Marketing budgets expanded rapidly, infrastructure investments multiplied, and hiring increased aggressively. Many firms operated with negative cash flow, justified by continuous access to external financing. The assumption that capital markets would remain receptive became embedded in operational planning. Despite outward confidence, structural vulnerabilities accumulated. Revenue models were often untested, customer loyalty uncertain, and operating costs underestimated. Profitability timelines extended repeatedly. These challenges were acknowledged internally, but deprioritized relative to growth targets. Financial sustainability was deferred, dependent on future market consolidation or acquisition. By late 1999, signs of imbalance became more apparent. Valuations reached levels difficult to justify even under optimistic scenarios. Market volatility increased. Some high-profile companies failed to meet growth expectations. Nevertheless, these developments were largely interpreted as isolated exceptions rather than systemic indicators. The turning point emerged gradually rather than abruptly. Monetary conditions tightened, reducing liquidity. Investor sentiment shifted toward profitability and cash flow discipline. As scrutiny increased, Companies reliant on continuous funding faced growing challenges. Capital access became selective, exposing firms whose business models depended entirely on external financing. Public market corrections followed. Share prices of technology companies declined sharply, erasing significant market value within months. Initial optimism gave way to reassessment. Companies once celebrated for innovation were now evaluated against traditional financial metrics. The gap between expectations and operational reality widened rapidly. Corporate failures accelerated. Numerous startups declared bankruptcy or ceased operations entirely. Others survived only through restructuring, mergers, or asset liquidation. Employment losses extended beyond the technology sector, affecting service providers, advertisers, and infrastructure suppliers interconnected with the digital economy. Established technology firms were not immune. Even companies with substantial revenues experienced dramatic valuation declines. Investor confidence recalibrated, differentiating between sustainable business models and speculative ventures. Market leadership became insufficient protection against declining sentiment. The broader economic impact was significant. Capital losses reduced household wealth. Pension funds and institutional portfolios absorbed substantial write-downs. While the global economy did not collapse, growth slowed and confidence weakened. The episode highlighted the systemic influence of financial market psychology. Regulatory and institutional responses followed. Disclosure requirements received renewed attention. Analysts faced scrutiny regarding conflicts of interest. Market participants reassessed the role of speculative narratives in capital allocation. While innovation remained valued, financial discipline regained prominence. In retrospect, the dot-com bubble was not driven by deception alone. Many participants genuinely believed in transformative potential. The error lay not in recognizing technological change, but in assuming that innovation automatically justified valuation without corresponding financial performance. The episode illustrates how collective expectations influence financial structures. When optimism becomes widespread, risk tolerance increases across institutions simultaneously. This synchronization amplifies vulnerability, as corrections affect multiple participants concurrently. Financial models evolve in response to such experiences. Post-bubble valuation frameworks emphasized revenue quality, sustainability, and governance. Investors became more cautious in interpreting growth narratives unsupported by financial evidence. Importantly, the collapse did not invalidate the internet economy. Many foundational technologies persisted and later matured into profitable enterprises. The adjustment represented a reallocation of capital rather than rejection of innovation itself. The cost of the dot-com bubble is measured in trillions of dollars of lost market capitalization. These losses reflect not a single failure, but the cumulative effect of widespread assumptions shared across markets. Lessons from this period continue to inform contemporary investment behavior. References to the dot-com era remain common during periods of rapid technological enthusiasm. It serves as a benchmark for evaluating speculative excess. This record does not suggest that markets should avoid innovation. Instead, it documents how financial logic can be distorted when growth narratives overshadow structural assessment. Balance between optimism and discipline remains central. The dot-com bubble reshaped venture capital practices, public market expectations, and regulatory oversight. Its influence extends beyond technology into broader financial governance frameworks. Economic history progresses through such recalibrations. Each cycle refines collective understanding of risk, valuation, and sustainability. The dot-com episode remains a defining reference point in this process. For institutions, adaptability proved essential. Those capable of restructuring survived and later prospered. Those unable to adjust exited the market. Financial flexibility emerged as a decisive factor. This archive preserves the episode not as a cautionary tale, but as a documented interaction between innovation, capital, and human expectation. Outcomes reflect context as much as decision-making. Understanding this period requires resisting simplification. It was neither pure speculation nor pure progress. It was a convergence of opportunity and excess, enabled by unprecedented technological change. This concludes the financial record of the dot-com bubble, an episode defined by confidence, capital, and consequence. Its legacy continues to influence how markets evaluate innovation, growth, and financial sustainability. This has been a Financial Archive.